Okay, let's unpack this. Today we're doing a deep dive into, well, insurance. It's really the financial backbone of security for so many things.
Absolutely. And our goal isn't just listing definitions, right? It's about understanding how it all works. Who's holding the risk, how the different kinds of coverage actually protect you.
Exactly. So insurance itself, fundamentally, what is it?
It's basically a contract. Simple as that. It provides financial protection or reimbursement, really, against losses you don't see coming, accidents, injuries, damage to your stuff.
Right. And the key mechanism is this idea of risk pooling.
Yeah, that's crucial. The insurer collects premiums from loads of people,
Hmm.
policyholders,
Uh,
and that creates this big pot of money, enough to cover the really big, but thankfully less common, losses that only a few people experience. It spreads the risk out.
Makes sense. That
Yeah.
distribution makes it affordable. Okay, so who are the key players in this contract? We've got the insurer, obviously the company.
Right. They pool the risk, pay the claims.
Yeah.
Then there's the policyholder. That's the person or, the company paying the premiums.
Yeah. And they own the policy. But they don't always have to be the person covered by the policy, the insured.
Correct. You can buy a policy on someone else or even on property, but, and this is important, you need what's called an insurable interest.
Insurable interest, meaning,
Meaning you'd face a real, measurable financial hardship if that person died or that property got damaged. You can't just, insure your neighbor's house hoping it burns down.
okay, got it. It prevents gambling, essentially. And the third role?
The beneficiary, that's who gets the payout, the
Yeah.
designated person or entity. Pretty straightforward in life insurance, but applies elsewhere too.
All right, players covered. Now, the nuts and bolts of the contract. What are the, let's say, three essential financial bits?
Okay, first, the premium. That's your regular payment.
Mhm.
And the price, it's all based on how risky the insurer thinks you are.
Uh-huh.
Age, health, driving record, where you live, all that stuff.
So it's personalized risk assessment. Number two.
The policy limit, sometimes called the face value in life insurance. It's just the absolute maximum amount the insurer will pay for a loss that's covered by the policy.
The ceiling on the payout. And number three, the deductible.
Ah, yes. The deductible, it's the amount you have to pay out of your own pocket for a claim before the insurer starts paying anything.
And choosing that deductible level is a pretty big decision, isn't it? It's not just some random number.
Oh, absolutely. It's where you decide how much small risk you want to handle yourself. A higher deductible usually means a lower premium. Why? Because you're telling the insurer you won't bother them with minor claims.
It's a trade-off. Pay less now in premiums, but potentially more upfront if something actually happens.
Exactly. It's a key part of managing your own cost versus risk.
Okay, mechanics understood. Let's look at how this applies to different areas. Life insurance is a big one. The financial safety net, really.
Definitely. Broadly, you've got two main types. Term life is usually the most affordable. It covers you for a specific period, maybe 10, 20, 30 years. If you pass away during that term, it pays out.
And lots of employers offer some basic coverage too, right? Group life.
Yeah, group life, often low cost or even free as an employee benefit. But it typically ends if you leave that job, so you need to be aware of that.
Okay. And the other main type.
Permanent life. Think whole life or universal life. As the name suggests, it offers lifelong coverage, assuming you keep paying the premiums. And importantly, it often builds up a cash value.
Right, the cash value component. That can grow tax deferred.
That's the key benefit. It's almost like a savings or investment element within the insurance policy. And companies, particularly banks, get quite creative with this.
You mean VOI, bank-owned life insurance.
Exactly. Banks buy these permanent policies on their key executives. The bank itself is the policyholder and the beneficiary. They use that tax-efficient cash value growth to help fund things like executive retirement plans. It's quite a specific but interesting use case.
Clever. Okay, shifting gears. What about protecting yourself from claims by others? Liability insurance.
Right, often called third-party insurance. Its whole job is to protect you if you accidentally injure someone else or damage their property. It pays the other party, the third party, not you.
Crucially, it doesn't cover intentional acts or crimes, I assume.
Absolutely not. It's for accidents, negligence. Businesses rely heavily on things like commercial general liability. Then you have specialized types like E&O, errors and omissions.
For professionals like architects or consultants.
Exactly. Protects them if their advice or service causes a client a loss. And D&O, Directors and Officers Insurance, protects corporate leaders from lawsuits related to their management decisions.
Okay, lots of variations there. Finally, let's touch on property insurance, protecting your actual stuff.
Yeah, this is a broad category. It includes renter's insurance, which is often called HO4, but for homeowners, the most common policy is probably the HO3. It's a kind of hybrid policy covering the structure broadly and the contents for specific named perils.
And there's specific flood or fire insurance, too.
Yes. Basic homeowners policies often have some fire coverage, but a standalone fire insurance policy might offer more extensive protection. Flood is almost always separate. Now, a really critical point here is how you get reimbursed after a loss.
Replacement cost versus actual cash value.
Yeah.
Big difference.
Huge difference. Actual cash value, or ACV, pays you the replacement cost minus depreciation, so that 10-year-old roof. You won't get the money for a brand new one.
Ouch.
Yeah. Replacement cost coverage, on the other hand, pays the current cost to repair or replace your damaged property with something of similar kind and quality without deducting for depreciation. It costs more in premiums, generally, but the payout is much better, especially for older items.
So really understanding which one you have in your policy is vital.
Absolutely essential.
Okay, so wrapping this up, what's the main takeaway here? Insurance isn't magic, it's a contract.
Exactly. It's a vital tool for managing financial risk, protecting your family, your assets. But you have to understand the specifics of the contract you signed. What are the limits? What's the deductible? Is it ACV or replacement cost?
Which brings us to a final thought. We mentioned liability insurance is often required for driving, for owning a home, because it protects the other person.
Right.
So, considering that, there's this other thing called an umbrella policy. It's often pretty affordable, and it adds extra liability coverage on top of your existing home and auto policies. What huge, often overlooked risk does that umbrella policy really protect you from?
It protects you from financial ruin, essentially. If you cause a major accident and the damages exceed your standard auto or home liability limits, maybe hundreds of thousands or even millions, that umbrella policy kicks in.
So it protects your savings, your house equity, your future earnings,
Yeah.
everything you own, from being wiped out by one catastrophic lawsuit.
Precisely. It's that extra layer of defense against the truly devastating financial hits, something definitely worth looking into.